Hey guys, SGT here, and I have the one and only Rob Kirby of Kirby Analytics, publisher of the Kirby Analysis newsletter. Rob is also author of the book The Gold Fix, and Rob's here to join us. Rob, thanks so much for your time.
Yeah, no problem. Nice to speak with you, Sean.
It's a pleasure. I think we've been on a conference call before in which Eric Sprott and others were on it. You're so well connected. You know Eric Sprott, Jim Sinclair, Jim Willey, all these guys. Rob received his economics degree from York University and then went on to pre-bond for 11 years, then to Freedom Bond Brokers, now part of Cantor Fitzgerald. Rob worked at Garban, the second biggest broker of government bonds, and Rob was around when these FRAs, forward rate agreements, were invented, which are essentially bets on LIBOR interest rates. So few people on the planet understand the depth and breadth of this LIBOR rigging scandal like Rob Kirby. So Rob, before we get into your article, LIBOR Rigging, the Tip of the Iceberg, I just want to gauge your reaction to this Daily Mail headline: ECB rides to rescue of Spain and Italy with long-awaited bond buying plan.
Well, Mario Draghi's press conference reminded me of John Cleese speaking in one of his famous Monty Python movies. His statement that they were going to do unlimited bond purchases in maturities 1 to 3 years, but it was all going to be sterilized, and that this was all within the mandate of the ECB is absolutely and utterly. I want to use the word preposterous, but that's not strong enough. To say it's hilarious doesn't really convey the seriousness of the situation, but it's needless to say it's a sad day. It's a sad day for finance. It's a sad day for humanity when somebody of his stature and somebody in a position that he's in gets up in front of the world, the free world, and makes such ludicrous statements. It's I don't know what else to say.
Well, it's like they're inventing new monetary terms. What is sterilized bond buying? Are they actually trying to get the world to believe that they're not printing money?
Well, that's what he did. He did actually say that. He said what we're doing here isn't printing money, but we're going to buy unlimited amounts of government bonds for in the maturities 1 to 3 years. Double speak. It's ridiculous. It's literally, Sean. I use the word. It's Python-esque. Because during Draghi's speech, the only thing that was really missing, as far as I'm concerned, was the big foot coming out of the sky to step on him. Because what he's saying is preposterous. Yeah,
the Monty Python Bigfoot crushing. You're right. It's like a comedy at this point. We all know it, those of us who are paying attention. I'm connected with some really high net worth individuals that run money for UBS and some other companies, friends of mine, that they still don't get any of this. They think zero hedge is just, that's for doom and gloomers. It just astounds me, Rob, that so many people in this current paradigm are still sound asleep. Hey, I'd be remiss, before we talk about this LIBOR scandal and getting into to what's really going on here, which includes ESF intervention, really at the crux of it, I think, is what you'd say. I want to ask you about what's going on in the silver and gold market. Bill Murphy predicted what we're seeing here in August. Now we're moving into September, and silver is just on fire. So is gold. What are your sources saying? Do you have any inside skinny for us on what's going on here, or is the world just finally waking up?
My view on the metal, Sean, is that what we're witnessing right now is a managed retreat, and we're seeing the managed retreat, and we're seeing prices rise rather quickly, actually, at this point. And the reason for this is much of the precious metal cartel that suppresses prices. They do most of their suppression with paper products, as in futures and selling of unallocated gold on the LBMA. And the thing is, you can only sell so many promises of gold before you have to start to pony up some real stuff to basically make you look like you're kind of telling the truth. And I think what we're witnessing now is people are realizing that the jig is maybe, and I don't want to say up yet, but there's continually a greater constituency saying, enough of the promises, show us the real stuff. And the real stuff, when people start demanding the real goods, that's when the price really starts to move. And if this is something that's going to continue going forward, which I suspect it might, we might not see these big pullbacks maybe for a little while. Like we could see a prolonged run. I believe at some point we're going to see a very prolonged run in the price of metals to the upside, and I think it's going to defy, when we do see it, I think it's going to defy a great many people who rely on charts and who are married to their technical analysis, because I think at some point in time that stuff is going to absolutely and utterly break down and be largely discredited. That's my view on that.
And we couldn't agree more. I think when this paradigm finally collapses, all of those charts will be chucked right out the window as well. Now, guys, what you're going to get here is really a history lesson, because this LIBOR scandal is so incredibly important, and the way that Rob understands it and can explain it can bring back the gravity for us all, because it seems like this LIBOR thing has to some degree been swept under the rug. And you write in your article, LIBOR, or the London Interbank Offered Rate, is one of the linchpins in setting global U.S. dollar interest rates. This is why a larger discussion needs to be had about the LIBOR rigging. It's not a London or Barclays-centric story. It has everything to do with making the American dollar look viable as the world's reserve currency. Where do you want to start?
The LIBOR fiasco is a manufactured event which was cooked up and manufactured in the Treasury Department of the United States. And absolutely and without a doubt, the timing of the LIBOR issue, it began, the start of the LIBOR breakdown occurred in the third quarter of 2007, and that was post-crash of Bear Stearns, and just after the credit markets seized up in the summer of 2007. And everyone should remember that the reason the credit market seized up was because formerly rated AAA subprime mortgage paper failed. And I think it was probably the first time in the history of credit markets that AAA rated paper actually failed. And the impact of the credit markets seizing up literally panicked the U.S. government into taking extraordinary steps in the U.S. Treasury to try and loosen or free up credit markets. And how this manifested itself was a secretive arm of the U.S. Treasury called the Exchange Stabilization Fund, which is beyond oversight of anybody. They entered the market through the New York Fed trading desk, and they started performing a series of short-term U.S. interest rate derivative trades with J.P. Morgan in the third quarter of 2007 to the tune of about $7.5 trillion worth in an instrument called a future or forward rate agreement, or an FRA, forward rate agreement. And the upshot of performing these trades with J.P. Morgan compelled J.P. Morgan to buy literally trillions of dollars worth of short-dated U.S. government securities or Treasury bills in the marketplace to hedge or book profit on these trades they were doing with the Treasury. This is what caused the cascade in interest rates, short-term interest rates, back in in Q3 of 2007, when we saw the 3-month T-bill rates literally collapse from roughly 5% down to 3% in a space of a couple of days. And then, of course, they did rebound a little bit before they continued their further decline, ultimately down to effectively zero where they are today. But people need to get their heads around the size of the interventions that were undertaken to make short-term rates go down, and we know that it was the U.S. Treasury acting through the New York Fed to do these trades, because the sheer amounts of them being done. I guess first, you know what? I'm going to actually back up just a little bit here.
Sure.
People actually should first understand, Sean, what an OTC swap is. And because I don't know whether you've reposted the article or not, but if anybody happens to be looking at this article, you'll see in the article there's some excerpts or some pictures of data tables taken from the Office of the Comptroller of the Currency in the United States, who publish a quarterly derivatives report. And in these tables, you see the instruments referred to as OTC swaps. And people need to know that what OTC swaps are in the short end of the, let's say 1 year and less predominantly, those instruments are called the FRA, or Forward Rate Agreement, which I spoke of just a little bit earlier. And then the other big classification under OTC swaps is interest rate swaps. And interest rate swaps between 1 and 3 years in duration are hedged and involve, when people buy and sell them, involve the purchase or sale of strips of Eurodollar futures to effectively hedge the trades. And between 3 and 10 years, interest rate swaps are traded on a spread over U.S. government securities, and thus they have a U.S. government bond trade embedded in them. One thing to note about all these products is that when they are transacted between two counterparties, each counterparty has to have a credit line for the other counterparty before the trade can be consummated. And you see, and the issue becomes when you have one institution doing $7.5 trillion worth of a credit-dependent product in a 3-month period, it begins to really stretch the imagination how any bank could perform such a volume of business in a 3-month period, because, you see, nobody has $7.5 trillion worth of credit line for J.P. Morgan. Right. So it really defies logic and credulity to suggest that J.P. Morgan could have actually done interbank trading of $7.5 trillion worth of this short-term credit-dependent product. And we know that the trade did occur because it's listed right in the data table of the Office of the Comptroller of the Currency.
Yeah, it's on page 4 in your article, where you show that JPM's book grew from $25.2 trillion in Q207 to $32.8 trillion in Q307, and then mysteriously they got to unwind that 3 months later, and that's how you know the ESF was involved, right?
And what that is evidence of, Sean. That is evidence. It's a flamethrower. It's in neon lights what that is. Those were 3-month FRAs that were put on at J.P. Morgan, and due to the sheer size, we know that the other side wasn't banks, and because of what happened in the interest rate arena, we know that J.P. Morgan was the payer, and we know that the only entity on the planet that could conduct that kind of trade with J.P. Morgan is government or quasi-government, because I don't believe the Exchange Stabilization Fund is really even government, because it's beyond oversight from government. And the Exchange Stabilization Fund is the only entity on the planet that has the kind of resources to conduct that kind of trade with J.P. Morgan.
Why don't you help us understand why this quote-unquote strong dollar policy, which is a Robert Rubin theoretical work that you write about here, what is this strong dollar policy, and why is it a bad thing for markets? Why is it a bad thing for all of us? Because clearly it is. Interest rates at 0% and this interbank lending and all this fraud and all this criminality, all it's done is destroy the system and the confidence in the system. So help us understand what's at the crux of the matter here. Is this just a mafia organization? Is this just evil at its highest matrix? I mean, help me understand what we're talking about.
There's a little bit more of a story to this than what might meet the eye to the average person. The strong dollar policy to me, I refer to it as the mythical strong dollar policy, because the U.S. dollar isn't strong fundamentally, and the whole notion of the strong dollar policy really is born out of academia. And in academia back in the 80s, and specifically at Harvard, a professor then at Harvard by the name of Lawrence Summers, who went on to become the Undersecretary of Treasury under Rubin and eventually became Treasury Secretary himself in the Clinton administration, post Robert Rubin. He did academic work. Lawrence Summers did academic work with another chap at Harvard named Robert Barclay. And Barclay and Summers together co-authored a paper on a concept or an economic concept referred to as Gibson's paradox. And the upshot of the work that they did on Gibson's paradox very unambiguously states that there's huge interrelation between interest rates, how interest rates are set, and the price of gold. And so the upshot of that was, and I would suggest to you the reason why Lawrence Summers, apart from being a consummate insider, but the reason why he was brought to Washington to be the Undersecretary of Treasury at the beginning of Clinton's first administration by Robert Rubin, who was the Treasury Secretary, was because he had done this work and and seemingly had a greater understanding of the relationship between the price of gold and interest rates, and how effectively rigging the price of gold or suppressing the price of gold would give the U.S. government / Treasury a free hand to lower interest rates without igniting inflation.
And the reason that they need to keep interest rates low is because the national debt is so high, that the debt payments are so onerous, that fair market interest rates, will be it'll bankrupt the country. Am I on the right track? I mean, in order for this paradigm to continue, they've exhausted all the bullets in the chamber to bring interest rates down to zero. They're now going negative.
Well, interest rates, Sean, have been negative. Real interest rates have been negative for a very long time. I mean, people should remember the work of John Williams of shadowstats.com. He does great work. He points out to us that inflation today, which the government in the United States says is around 2% per year, he tells us that if we measured inflation today the same way it was measured back in 1990, our current inflation rate would be around 5%. And then he goes on to say that if we measured inflation today the same way it was measured back in 1980, that our current inflation rate would be around 10%. And just remember, it was 10% inflation, or maybe a little higher, but I mean, let's just say double-digit inflation back in the 1980s that caused Mr. Volcker to raise short-term interest rates up to 21%.
That's right. And, John Williams has also been forecasting for a very long time that we probably will see hyperinflation in the United States sometime between 2014 to 2016. And I think he's skewing closer to 2014 as being his target date for that, based on the real economics, based on his real number crunching. What does a post-dollar world look like? A post-world's reserve currency dollar world? What does that look like, Rob?
Oh boy, that's a really, really good question.
Friends, thanks for watching part 1. Stay tuned for part 2. It's called The Endgame for Our Currency, Worthless. There's a link below in the info section. And please check out thelibertymill.com. Real news 24/7. Thanks for watching.